Unfortunately, borrowing money isn't free. You do have to pay it back plus interest. Now, the way interest works, essentially when you're looking at different loans, have it be a federal loan or a private student loan, you're gonna see an interest rate attached there. And it's not as simple as understanding what that interest rate is. There's a little bit more and a little bit more digging you should do to understand how student loan interest works. There's two different ways that interest can be applied. It can be applied either using a simple daily interest calculation or a compounding interest calculation. For the most part, when we're talking about student loans specifically, interest will probably be calculated using a simple daily interest formula. And what does that mean? Essentially, you will only be charged interest on your outstanding principal balance, not on your outstanding principal balance and any outstanding interest you have. So that's important to keep in mind on how a simple daily interest calculation is used. And just in case you encounter something that's talking about compound interest, a compound interest formula will charge you interest on the amount you borrowed, your principal balance, as well as any outstanding interest you also have. Now, what you also need to know is what type of student loan do you have? Do you have a federal student loan? Is it a subsidized federal student loan or an unsubsidized federal student loan? Because these things do matter. If you have a subsidized federal student loan, like a direct Stafford subsidized loan, there's a reason why this loan is beneficial and why people want to have that type of loan over other types of loans. It's because there is an interest subsidy while you're enrolled in school at least half time, during your grace period, and during periods of authorized deferment. And during those periods, you actually have your interest covered by the government. That's also why it's known as a need-based loan. It is a loan that has great borrower benefits attached to it. Now, if you have an unsubsidized federal loan, something like a direct Stafford unsubsidized student loan, or a direct plus loan, and that could be either a grad plus loan or a parent plus loan, the loan does not have a subsidy, meaning interest is accruing in your responsibility to repay along with the amount you originally borrowed on the date it's actually dispersed to you. And for private student loans, there are no subsidies covered by the government or anybody else with a private student loan. Kind of like the unsubsidized loan in the federal program, interest will be your responsibility from the day that loan is dispersed to you. Even though we're talking about how interest is only going to be calculated based on your outstanding principal balance, that doesn't mean that your outstanding principal balance can't change. There is something known as interest capitalization. How interest capitalization works when we're talking about student loans. There are certain periods of time where your lender or your servicer can take any outstanding interest and capitalize it or add it on to your outstanding principal balance, meaning you're increasing your total outstanding principal balance. That would also change how your interest is being calculated using the simple daily interest formula. It'll be off of that higher amount than the amount you originally borrowed. In the federal program, there's very specific times where your lender or servicer is allowed to do this. When it comes to private student loans, you want to double check and read your terms and conditions to see how often your lender will be capitalizing any outstanding interest onto the principal balance of your loan. When it comes to the federal student loan program, some common times this happens, any change in repayment status. So going from an in-school and grace period, like a common thing before you enter repayment, and entering that repayment status is actually a capitalization event, which means your servicer will take any outstanding interest before you start making payments on your loan, if there's any there, and then capitalize that and add it to your principal balance, and then you'll start making payments based on your repayment term, the repayment plan you picked, and so forth. So that's why we and many others out there who work with different financial products will recommend that you make interest payments while you're in school. So when you get to the time where interest is going to be capitalized before you enter repayment, there's nothing to add on to that principal balance. So that's just something to keep in mind and get an idea of why we always give that advice to make payments while you're in school, at least to cover your outstanding interest. Same thing with private student loans, same advice there. If you're in school and you're able to, you should at least make payments to cover the interest that's accruing every month in order to avoid any capitalization or any additions onto your principal balance. Some lenders will actually, with a private student loan, give you that option up front. When you take out that loan, they'll ask you for different ways you want to plan to repay that loan. You can actually build it in from the beginning and choose an interest-only payment while you're enrolled in school and meet all the other eligibility criteria on that loan. There's other ones that are offered like deferred payment, which would follow more of that federal model, when your loans aren't required to start repayment until you drop below half-time enrollment, and then you have a grace period on top of that. But keep in mind, if you're borrowing loans your freshman year and you're planning to be there for 4 years and they're unsubsidized funds, meaning interest will be your responsibility, you've got at least 4.5 years, so you got your 4 years in school and your 6-month grace period, where that loan is just getting more and more expensive because you're gonna have interest charged every single day on there. Now, if you see something like a 5% interest rate, that doesn't mean, because we've got a lot of confusion of what that really means and how it's calculated. It's not to get too technical, it's not actually 5% of your loan. That's not what that means when it comes to applying interest to the amount you've borrowed. The way the simple daily interest formula kind of works is you take the amount you borrowed, say $5,500, and multiply it by your interest rate of 5%, and then you divide that by 365, the total days in a year. And that will actually give you your daily cost of your loan. So in this example of a $5,500 loan with a 5% interest rate, your daily cost is about 75 cents. Now 75 cents doesn't seem like a really big number for one day. But say you're not making payments on your loan and your interest is accruing at that 75 cents for 365 days. By allowing interest to accrue for 1 year, you're adding on an additional $275 to your loan. Once again, some people might think that's not that crazy for a whole year. But if you're having that loan just accrue interest for 4.5 years, that can be about $1,500. So you're adding an additional $1,500 to the amount you borrowed on your loan freshman year. Now that's a pretty simple example. There could be other factors that could change the way your interest is calculating, but that's just to get an idea of how much a loan can cost you over time. So interest, it's definitely important to go out there and compare different interest rates and also understand how they're applied to your loan. If you have a subsidized loan, you actually get a little bit of help there. You have some time where the government will be responsible for covering the interest on your behalf, but it does not last forever. Also, if you have an unsubsidized loan, you want to know that the interest will be your responsibility the whole time. That's why understanding what's in your financial aid offer letter is so incredibly important, to understand different terms and conditions on there. And if you're seeking something like a private student loan, read those terms and conditions as well to understand what type of formula they're using to apply interest on your loan and how much that will cost you over time. My name is Elaine Rubin. For more information about paying for colleges, finding scholarships, or student loans, make sure to subscribe.